Imagine flipping a coin, right? And every single time it lands on heads, you make $1 million.
That would be nerds.
Yeah, I mean, sign me up. But for decades, traditional finance experts have basically told you that predicting the stock market is exactly like that coin flip. They call it this completely random walk.
Right. You hear that everywhere.
You really do. You hear from casual day traders. You hear from talking heads on TV. But today, we are doing a deep dive into a paper that claims that an entire idea isn't just a little bit imprecise. It's actually, well, it's a massive illusion, and it's completely wrong.
It really is. I mean, the phrase random walk borrows a very specific concept from physics and pure mathematics, and then it just sort of haphazardly slaps it onto human economics.
Right.
And that creates just a tremendous amount of confusion about what is actually happening under the hood when a stock price moves.
And that is exactly what we are getting into today. We were pulling from a 2026 paper. It's titled, Markets Are Not Random, They Are Hard to Predict, and it's by Mikel Noguer-Alonso out of the Artificial Intelligence Finance Institute.
It's a fantastic paper.
Yeah, really eye-opening stuff. So our goal here is to figure out why financial markets feel so chaotic and random when they actually aren't. We'll look at how the market practically functions as like an organism that hides its own patterns, and why understanding that distinction fundamentally changes how you should view risk and investing.
Absolutely.
Okay, let's unpack this. To start, I think we have to establish what kind of unpredictability we are even dealing with here.
Yeah, that is the core of the paper's argument right there. It draws this very hard, almost philosophical line between two completely different types of randomness. We have to separate what is known as ontic randomness from epistemic unpredictability.
Okay, wait, I'm going to need a translation on ontic and epistemic.
Fair enough. So think of ontic randomness as true fundamental randomness. Like, it is literally built into the fabric of the universe.
Like what, for example?
Well, the classic undeniable example is quantum mechanics. When a physicist measures a subatomic particle, the outcome is random, and it has literally no underlying cause.
None at all.
None. There are no hidden variables that our instruments just missed. I mean, even if you had an all-knowing magical supercomputer, you couldn't predict the outcome.
Oh, wow.
Because the information simply does not exist in the universe until the event actually happens.
So it's fundamentally physically uncaused, like a true roll of the dice where the physics, the gravity, the friction of the table, they don't even matter. The universe just decides in that exact millisecond.
Yes, that's onpodic. But financial markets are not subatomic quantum particles, right?
Right, thankfully.
Markets fall under the second category, which is epistemic unpredictability. This means that an outcome is completely determined by a strict chain of causes. But those causes are just way too complex or too obscured for us to see.
Okay, so the causes are there, we just can't track them.
Exactly. Stock prices are macroscopic, human-driven economic objects. Every single price tick on a screen has a tangible causal chain.
Right, actual real-world events.
Yeah. Information breaks, someone interprets it, an order is generated, it routes to an exchange, and it executes. There is a physical, traceable reason for every single fluctuation. So it is epistemically hard to predict because we don't have all the facts, but it is not unmistakably random.
Wait, hold on. I'm stuck on something right out of the gate here. If every single tick has a literal cause, like a human pressing a button or an algorithm executing a trade because the CPI data came out, why are we treating the stock exchange like a roulette wheel?
That's the paradox, isn't it?
Right. Why is every single quant on Wall Street using probability models that treat the market like a giant casino? I mean, if there are real causes, shouldn't we just be modeling the causes?
What's fascinating here is that it all comes down to scale. The sheer volume of hidden causes forces us to treat it as if it were a casino, even though we know for a fact it isn't.
Just because there's too much data.
Yeah, think about what a market actually is. It is an aggregator of an unimaginably large number of unobservable variables. We are talking about millions of individual traders, private portfolios, secret corporate inventory levels, institutional margin constraints, hidden beliefs, panic, greed.
It's just a giant soup of human behavior.
Exactly. And no single person and no supercomputer on Earth can observe all of those moving parts simultaneously. So the only rational, mathematically sound response is to model it probabilistically.
Okay, so it's less like a coin toss and more like, I don't know, trying to predict the weather. We know the physics of clouds and wind, we just don't have enough sensors in the atmosphere to track every single gust of air.
The weather is a good analogy, yeah. But physicists actually have a better one, which is a sealed container of gas.
Okay.
When physicists look at a pressurized tank of gas, they know there are trillions of individual molecules bouncing around inside, and each molecule follows the strict laws of physics. Like, if it hits a wall, it bounces off at a specific angle.
Right, cause and effect.
Exactly. But they don't even attempt to track every single bouncing molecule. It's impossible. Instead, they use statistical mechanics to describe the aggregate behavior, like the overall pressure and temperature of the tank.
Oh, we see.
Finance does the exact same thing with millions of daily price movements. We use probability to cope with our own ignorance.
Okay, that makes sense.
Yeah.
We are fundamentally blind to the vast majority of the data, so we use probability as a crutch. But the paper points out that once finance accepted it had to use probability, the industry did something incredibly bizarre.
Oh, yeah. This is wild.
They didn't just use real-world probability. They actively invented a fake probability to price assets.
Yes, and this is arguably one of the most brilliant but counterintuitive leaps in the history of modern finance. It's known as the PQ wedge.
PQ wedge.
Yeah. In mathematical finance, the letter P stands for the real-world probability measure. It represents the actual messy odds of what will happen in the physical world, complete with all its risks and rewards.
Okay, so P is reality.
Right. But Q is an alternate universe. It is what quants call the risk-neutral pricing measure. Every practitioner on Wall Street knows that Q does not describe the real world, yet they deliberately swap it in, completely ignoring P, purely because it makes the mathematics of pricing complex derivatives actually solvable.
I need to visualize this. What exactly happens when they swap the real-world P for this fake universe Q?
Let's use the S&P 500. In the real world, the P universe, stocks carry risk, and because they carry risk, investors demand a reward for holding them. We call this the equity premium.
Makes sense. More risk, more reward.
Right. So maybe you expect the S&P 500 to grow by 8% this year, while a super safe government treasury bond only pays 4%. That extra 4% is your predictable reward for taking on stock market risk. But under Q, the risk-neutral universe, that equity premium is completely erased.
Wait, erased? They just pretend the extra 4% doesn't exist.
They mathematically deleted.
That's crazy.
I know. In the Q universe, they assume every single asset, no matter how incredibly risky it is, just earns the exact same safe 4% treasury rate. By pretending no one cares about risk, the equations used to price things like options and futures suddenly become clean, elegant, and solvable.
Wow.
But here is the profound takeaway from the paper. The distance between the real-world P and this artificial math tool Q is literally the market price of risk.
That is wild, because the fact that the entire financial system relies on a probability measure that they explicitly know is a fiction, well, it proves they don't actually believe the market is fundamentally random.
Exactly.
I mean, if the randomness was a hard law of nature, you couldn't just invent a parallel universe to make your spreadsheet work.
No, you couldn't. It's an instrument. It's a lens you look through to get a specific job done. And this leads us to how we actually dissect a real-world price movement. If we go back to the real world, the P measure, the paper highlights a mathematical concept called the Doob decomposition.
The Doob decomposition.
Right. It's a theorem that proves mathematically that you can take any asset's return over time and split it into two distinct separate parts.
Okay.
One part is predictable, which is that slow-moving risk premium we just talked about. The other part is completely unpredictable, which mathematicians call the martingale innovation.
Wait, how do you actually split a single price movement in two? Like if a stock jumps $2 in the day, how does the math know which part of that $2 was predictable drift and which part was just random noise?
Think of it like a river. The predictable part, the drift, the risk premium, is the deep underlying current of the river. It is constantly pulling in one direction over a long period of time because it is compensating investors for the time value of money and the baseline risk of the economy.
Okay, so that's the slow, steady pull.
Right. The unpredictable part, the martingale innovation, is the chaotic splashing and the waves on the surface. That splashing is driven by the news of the day. An earnings miss, a geopolitical event, a sudden change in interest rates. The Doob decomposition uses conditional expectation, essentially looking at the average behavior given all past information to separate that deep current from the surface splashing.
And the splashing part is what they call a martingale. That's a term that usually gets thrown around in the same breath as random walk.
It does, and the paper is adamant that we stop confusing the two. They are not the same thing. A martingale simply means that the next increment has a conditional mean of 0.
Meaning Based on all public information sitting on my desk right now, I have absolutely no way to predict whether the very next move is going to be up or down.
Right. But that is not a random walk. In a true random walk, like flipping a coin, everything is independent and the variance is constant. The coin doesn't suddenly become heavier or lighter on a Tuesday. But in a martingale, the direction might be a coin toss. But the volatility, how wild that splashing on the surface is going to be, is highly predictable.
So even if I can't guess the direction, I can absolutely predict the intensity.
Yes, exactly. We know that volatility clusters. If the market is going crazy today, it's highly probable it will be going crazy tomorrow. We can forecast jump intensity around an earnings call. We know that financial returns have heavy, fat tails, meaning extreme crash-level events, happen way more often than a normal bell curve would suggest.
It's not totally random.
No, all of that complex, predictable structure lives comfortably inside a martingale. It is a highly structured chaos, not a random walk.
Okay, but this brings up a massive contradiction for me. So if the Doob decomposition proves mathematically that there is a predictable drift, that underlying current in the river, why aren't we all just trading on that drift and getting rich?
I know, it sounds easy, right?
Yeah, I mean, if a piece of the return is mathematically defined as predictable, why isn't it just an infinite free lunch for hedge funds?
Well, if we connect this to the bigger picture, you realize the math doesn't operate in a vacuum. First of all, you have to bear the exact risk that the drift is compensating you for. It's a premium for suffering through the volatility. But more importantly, from a statistical standpoint, that predictable current is incredibly faint.
How faint are we talking?
The paper brings up a famous 1980 study by the economist Robert Merton. He showed that you can't just sample data faster to see this drift.
What does that mean? Sample data faster, like looking at minute-by-minute charts.
Well, if you want to measure volatility, you can just look at tick-by-tick data.
Yeah.
You can measure the splashing of the waves in a single afternoon and get a very accurate reading of how violent the river is. But Merton proved that to measure the underlying drift, zooming in doesn't help at all.
Because it's too slow.
Yes. Because it's a slow-moving fundamental force, you literally need decades of calendar time to measure it accurately. The deafening noise of the daily market completely drowns out the quiet signal of the drift.
So even with a supercomputer analyzing microsecond trades, it's blind to the drift, because the drift only reveals itself over a 10-year horizon.
Precisely. And that introduces the massive gap between what is theoretically predictable and what is actually exploitable in the real world.
Here's where it gets really interesting, because let's say you do build the perfect model. You see through the decades of noise, you spot a genuine, mathematically predictable pattern that everyone else missed. You still might not make a dime.
Right.
It's like finding a secret empty shortcut during rush hour traffic, but there's a toll booth right in the middle of the shortcut, and the toll costs exactly the value of the gas and the time you just saved. The shortcut is real. The prediction was accurate, but exploiting it nets you exactly zero.
That is a brilliant way to conceptualize the limits to arbitrage. Just because a signal exists on a researcher's whiteboard doesn't mean it survives contact with the real world. Turning a mathematical signal into a live trade introduces explicit physical costs. You have bid-ask spreads. You have broker-borrow fees. You have capital constraints. And this leads to a vital concept called the finite capacity of alpha.
Meaning a strategy can only hold so much money before it breaks.
Exactly. You might find a true profitable signal, but the moment you and everyone else who found it start pouring billions of dollars into it, your scalable value gets entirely eaten by the cost of trading it. The heavier your footprint, the more you move the market against yourself until the profit completely vanishes.
Which brings in models like Milgram, right? The paper talks about market microstructure, which basically proves that the friction isn't just an accident, it's the market actively defending itself.
Yes, let's walk through the mechanics of that because it's crucial. Models like Milgram or the Kyle model show that you are never just a passive observer in the market. The moment you submit a trade, you are an active intervention. Imagine you are a market maker. Your job is to sit there all day and offer to buy or sell a stock to anyone who asks, making a tiny profit on the spread.
Okay, I'm the market maker.
Now, a massive hedge fund suddenly submits a colossal buy order for 1 million shares of a niche tech stock. As the market maker, you don't know why they are buying. You don't have their secret predictive model. But you aren't stupid.
Right.
The Milgram model proves that you will immediately assume adverse selection, meaning you assume this giant buyer knows something you don't.
Right, they wouldn't be buying 1 million shares if the company was about to go bankrupt.
Exactly. So to protect yourself from getting fleeced by an informed trader, you instantly raise your asking price. The hedge fund's very attempt to exploit their prediction caused the price to jump, which destroys the mispricing they were trying to profit from in the first place. You don't just observe the market, your actions alter its fabric.
So even if you manage to pay the toll booth, your own car ruins the shortcut for everyone. But what if you take a long-term position? Like you know a company is wildly undervalued, so you just buy it and wait. You bypass the high-frequency toll booths altogether.
Then you run into the survival time problem. The classic saying in finance is that the market can remain irrational longer than you can remain solvent.
Oh yeah, I've heard that one.
It's true. You might have a perfectly predictable, mathematically sound convergence trade. But if a panic hits and the market swings wildly against you in the short term, your prime broker is going to issue a margin call. They will force you to liquidate your position at the exact worst time. You are mathematically right about the long-term prediction, but you were financially ruined by the short-term noise.
Man, that is brutal. Okay, so we've layered this up. We started with the heavy math. We know the P and Q universes. We know how the Doob decomposition separates the current from the splashing. Then we move to the physical roadblocks, the transaction costs, and the market makers defending themselves. Now we arrive at what feels like the ultimate philosophical reason markets are so hard to predict.
Yes, and this is where we leave the realm of physics entirely and enter pure human economics. It is the concept of reflexivity.
Which is the idea that the market is a game that changes its own rules while you are playing it.
Exactly. Think back to our weather analogy. The weather is incredibly complex, but it doesn't care about your forecast. If a meteorologist predicts a hurricane, the hurricane doesn't read the report, realize people are boarding up their windows, and decide to change course just to spite them.
The atmosphere is indifferent.
But markets are not. Markets are reflexive. Predictability in a market is fundamentally self-defeating. If a pattern becomes obvious, competitive, profit-seeking agents will swarm it. They will trade it until the conditional mean is driven back to zero. The prediction literally destroys the pattern it predicted.
Which brings us to the Grossman-Stiglitz paradox. This is one of the most elegant concepts in the whole paper.
It really is. The paradox poses a simple logical trap. If financial markets were perfectly efficient and completely unpredictable, as the extreme random walk theorists claim, then no one could ever beat the market.
Right.
And if no one can beat the market, no sensible person would ever spend millions of dollars buying Bloomberg terminals, hiring analysts, and running supercomputers to research stocks.
Because it would be a complete waste of money.
Exactly. But if everyone stops doing research, no one is analyzing the data to find mispricings. And if no one is finding mispricings, the market instantly becomes wildly inefficient and highly predictable.
It's a catch-22.
It is. So Grossman and Stiglitz proved that for a market to function, it cannot be perfectly efficient. It must be slightly predictable. It has to leave just enough crumbs on the table to pay for the immense cost of the analysts and the computers doing the work of price discovery. The unpredictability isn't a flaw in the system. It is the rent the market pays to remain functional.
It's an incredibly delicate balance. But just when you think you can navigate that balance, the paper drops the final boss of unpredictability, Knightian uncertainty, or what they sometimes call ambiguity.
Right. Classical randomness, even complex probability, assumes you know the rules of the game. Imagine you are drawing from an urn. You might not know what color marble you're going to pull next, but you know for a fact the urn contains exactly 50 red marbles and 50 black marbles. You can calculate the exact odds.
You are dealing with known unknowns. The risk is quantifiable.
But Knightian uncertainty means you are drawing from an urn where you don't know the ratio. Worse, you are drawing from an urn while the dealer is under the table, constantly swapping the marbles, changing the colors, or maybe throwing in some dice just to mess with you.
That sounds like a nightmare.
The composition of the market constantly changes. We experience massive regime shifts. A global pandemic breaks out. A central bank invents a completely new monetary policy. A technological breakthrough like generative AI redefines an entire sector overnight.
So you aren't just calculating risk anymore. You are operating in deep, unquantifiable ambiguity.
Exactly. You are trying to predict the outcome of a game where the laws of physics are being rewritten every few years.
So what does this all mean? Like, how on earth do professionals even begin to measure a system like that? If the rules are changing and the market actively fights back against your predictions, how do you put a number on it?
This raises an important question, and the paper unifies all of this under one strict mathematical concept: entropy.
Entropy.
Yeah. In information theory, entropy is the measure of unpredictability or disorder. Whether you are dealing with the volatile splashing of a martingale, the self-defeating nature of reflexivity, or the shifting marbles of Knightian uncertainty, they all boil down to entropy. The market essentially acts as an organic machine that maximizes its own entropy to survive.
It protects itself.
Yes, it hides its causal chain behind millions of aggregated variables. And whenever a weak, predictable signal leaks out, the market's competitive immune system devours it, converting that useful information right back into chaotic noise.
So if you are sitting at home looking at your brokerage account, wondering if you can outsmart the market by finding a hidden pattern, the takeaway here is pretty profound. The market is absolutely not a random coin toss. It is a highly complex, doubly causal system. Every move happens for a reason. But it is incredibly hard to predict exactly where it matters most because prediction is expensive, it is fiercely competitive, and ultimately it triggers the market to adapt and erase the very pattern you found.
The causes are all there. They're just heavily guarded by transaction costs, human behavior, and constantly shifting regimes.
Which leaves us with a pretty fascinating final thought to ponder. If predictability is constantly being hunted down and destroyed by human traders, what happens to this ecosystem in a world that is increasingly dominated by artificial intelligence?
That is the million-dollar question.
Right. As machine learning models become infinitely faster and cheaper at finding these deeply hidden, faint signals, what is the end game? Will the market become a perfectly efficient, completely unreadable wall of white noise? Or will AI invent entirely new regimes of Knightian uncertainty, creating complex machine-speed feedback loops that human brains can't even comprehend?
It's the ultimate arms race between information and entropy, and the machines are just getting started.
They really are. Understanding that a system isn't just mathematically random and actually grasping the mechanics of why it hides its secrets from you is the very first step to true knowledge. Next time you hear someone casually say the stock market is just a random coin toss, you know exactly how heavy that coin really is and how many toll booths are hiding on the way down. See you next time on The Deep Dive.